Hello, I'm Jason Kelly. Thank you for joining me today. In this video, I will show you how to keep a long-term perspective in the stock market. If you've read any of my stuff, my books or the Kelly Letter or articles, or seen many of these videos, you will know that I am a believer in stock market systems, not picking and choosing individual winners. But even long-term winning, robustly researched systems will have down periods, rough patches, difficult times along the way that seem very long to us and unendurable, but are actually very tolerable when seen along that long-term perspective. Look here at the 100-year chart of the Dow Jones Industrial Average with a log scale. Put it up on your screen there. Now this goes back 100 years. Look at how it had a nice rise up to that first peak in the beginning there. That tall peak was 1929, and that's when we had the big crash and headed down into the bear market that followed. Now, you can imagine at the time that was a big deal, and a lot of people suffered badly because of it, and it's still in our collective psyche. Everybody is constantly worried about the next big crash. But look at this, over all of pretty much everybody's lifetime watching this video, I assume, the market's been steadily rising. And on this long-term perspective, you can see how even things that have felt really big in our lifetimes disappear along this longer term. But they sure didn't feel like they were no big deal at the time. Over here, just to the right of the 2000 line, notice that little hiccup going down there? That was the dot-com crash. And then the next big crash, which looked like a mini version of 1929, that crash over there was the 2008 financial crisis. Those were a big deal at the time. Oh, by the way, I should mention these charts are from, this chart is from macrotrends.net, and I'll use another one from them in a moment. This long-term rising line is why buy and hold works. If people would only do it, but they don't. They buy and hold until things get really uncomfortable, and then they sell, which is the worst possible time and destroys the performance of any system. Why? Because sometimes the market does this. Okay, now look at this chart on your screen, again, macrotrends.net. This is the 1929 crash and bear market on a log scale. So we're zooming into that big crash. You can see the peak in 1929 and a steady ramp down to the lower right part of the chart, 1932 summer. That's when it finally ended. By then, people had just about had it. I mean, look how long this is, more than 2 years of this kind of collapsing. It felt like a lifetime at the time. Looking at this, just this one chart, the conclusion of most people would be, well, I'm certainly going to avoid stocks. I'm certainly going to be careful with stocks. I'm certainly not going to allocate too much of my wealth to stocks because you just can't trust them. But what we know from the longer term perspective of this one crash is the thing to have done during this was buy like mad. All the way down this line, people should have been plowing capital in. Now, of course, ideally, all the money would have gone in at in July of 1932. But just buying anywhere along this descending line would have proven very profitable before too long had gone by. But we don't feel this at the time. Now, systems need to be ready for this. Systems need to be built so that they are exposed enough to that long-term rising line of the market, but with some kind of safety, some kind of buying power preservation built into them so that when the crashes happen, rare, but they do happen, when they happen, the system can jump on those because those are the times when big profits happen. Buying the big crashes is when you get ahead later on. Constant rising, if we truly did just always rise, then 100% allocation to stocks would be all you need. But look at how, if we go back to that long-term chart again up on your screen, look at how the thing to do was buy during that crash on the 100-year chart, right? And then notice how bears have missed all the profit since the crash of 2008. We'll put a red circle on that crash of 2008. And you can see how the market's gone up nicely since then, and the bears have been warning all along that another crash is on the way. Another crash is on the way. The long term is, well, long. It's very long. So when people start getting upset after 2 months of down prices or one missed opportunity in a quarter, it feels like forever. And I've experienced this myself on the front lines because I do write a letter for the general public when my system, which is a proven winner through most market environments, not all, come back to that in a minute, but It's going along just fine. 1 year, 2 years, 3 years, and the notes I get are happy, happy, happy. And then the system will go through 2 months of a rough patch, and I will start getting notes that say, is this broken? Has this stopped working? Are small caps going to fail to outperform ever again? Is everything we ever learned in stock market history out the window now? It is remarkable to see how quickly people will forget what has worked for a long time immediately after it pauses working, and that's all it ever is just a pause. Now, when you think about it, what you would really like is for the stock market to drop to zero and then go sideways, not really zero, but go to a very low level and then go sideways for the next 29 years of the 30 years that are your prime investing period. That's what you'd like, a totally flat sideways market for 29 years, during which you could add every single dollar of extra savings you could gather along the way, because you'd be getting a wonderful price there, right? And then in year 30, the last year before you're going to start taking money out of the market and retire, that thing shoots to the moon. That's actually the ideal shape for your investment program. Sideways, 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 29 years, and then wham, the thing goes up 1,000% in that last year. Of course, that'll never happen, but I'm just illustrating the point. That long sideways 29-year period would be fantastic for your investment program. But you know what you would think along the way, very quickly along the way, is this thing doesn't work. Stocks are dead. The cover of every magazine says so. Every pundit says so. The newspapers say so. Stocks are dead, stocks are dead, stocks are dead is what they would say. And after 29 years, I have to admit, I'd be kind of wondering about this idea myself. All of us are susceptible to this, but that's actually the pattern you would like. So, what do we learn from this? That we need a system that adapts, does the best it can. The goal of any long-term system is to create the highest allocation to stocks it can manage while still remaining prepared for the very rare but occasional crash in the market. That's the best you can do. Because you have to create that balance, every single system will go through periods of underperformance and just outright disappointment. Every single system. For example, recently, momentum systems have been hot, very hot. New books on them come out. People love momentum these days. But the outperformance chart they look at goes way back to the 1970s, and the bulk of that outperformance is in the 1970s and 1980s, some of it in the 1990s too. What have momentum systems done recently? Nothing. Look carefully at those charts. Compare the annual performances. Momentum has not beaten the S&P 500, most momentum systems, in even a single year since the crash of 2008. Not once. That's getting to be pretty long by now. Is it the fault of momentum? No. The historical returns are real. The point is just very long terms of underperformance can happen in every system. Mine too, just to be clear. My system has soundly beaten the market in this century, but if we go back through all market history, you can find time frames where my system would have lost. Why? Because when the market rises relentlessly, from your perspective this way, relentlessly, and my system is not 100% allocated to it, it will fall behind. I need price fluctuation. So frankly, these days, my system would love to have some lower prices. The point here is for you to deal with the long term, you have to really get into your bones and into your mind how long the long term is, and put your emotions on a shelf to see that what happens this month, the headline of the day, what happens this quarter, what happens even in the next 2 years is probably not relevant to the long-term behavior patterns we know exist in the stock market. So try to get some perspective. Will you do it? Probably not. I have to admit, emotions rule the day with everything human beings do, and I know as soon as we get the next crash, I will be inundated with fear letters again. But hey, this needed to be said because this is the truth. It's hard to control and it's hard to grasp, but it is true, and I hope you'll give it some thought and try to get your reactions under control. All right, thank you for watching. If you like this video, please subscribe to the channel on YouTube and give me a thumbs up here. If you are a Kelly Letter subscriber, I will see you Sunday. Everybody else, have a wonderful weekend.